Hey everyone, welcome. Let's be honest. Does your trading sometimes feel, well, chaotic? Like you're just reacting to market noise without a real plan? Today, we're going to change that. We're going to break down a systematic approach to Forex trading that turns all that guesswork into a structured, repeatable strategy. Let's dive in. You know that feeling, right? Staring at endless charts, getting conflicting signals. It's so easy to feel completely lost and overwhelmed by all the noise. But what if you had a clear blueprint to cut right through it? Well, that's exactly the blueprint we're going to build together today. So here's our game plan. First, we'll cover the core idea behind this whole approach. Then, we'll dive into the 4 key pillars you absolutely need to know. We'll piece those together into a 6-step blueprint, and then, the fun part, we'll watch it all play out in a real trade. And finally, we'll talk about why this whole thing actually works. So let's get one thing straight right off the bat. This is not about luck. It's not about some secret magic indicator. It's a system, and the goal is actually pretty simple, but it's incredibly powerful. We want to get all of our time frames singing the same tune. And, this is the big one, we want to trade with the big money, with that institutional order flow, not get run over by it. This entire strategy really just boils down to 4 core components. You can think of them as your essential toolkit. We've got the impulse break, imbalance, supply and demand zones, and session liquidity. Once you really get a handle on these 4 things, you've basically built the entire foundation for the system. All right, let's dive in. We're going to break down each of these 4 pillars, one by one. I want you to see exactly what they are and why each one is so crucial for finding those high probability setups. Okay, first up, the impulse break. Now, listen, this isn't just any little blip on the chart. We're looking for a big, decisive, strong-bodied candle that smashes through and, this is key, closes past a major structural point. That one move basically tells us, hey, that last trend, it's over. It signals that momentum has officially shifted. This is our first huge clue. Next, we have something called imbalance, or what a lot of traders call a fair value gap, or FVG. Think of this as the footprint left behind by the big guys, the institutions. See, when they need to move massive amounts of money, they do it fast, and it can leave these little voids, these gaps in the market. And here's the cool part. Those gaps act like magnets, almost pulling price back to fill them in later. So you see that powerful impulse break we just talked about? Well, where did it come from? That starting point? That's our demand zone. It's usually that last down candle right before the explosive up move. And when you find this zone sitting right next to one of those imbalance gaps, boom, that becomes our area of interest, a super high probability spot to look for an entry. And finally, our 4th pillar. Where are we aiming to take profit? This is where session liquidity is king. The highs and lows of the big trading sessions, Asia, London, New York, are just packed with orders. They're literally giant pools of money, and price is drawn to them like a magnet. That makes them the most logical, high-probability targets for our trades. Simple as that. Okay, so we've got our 4 tools. Now it's time to assemble them. Let's build the machine. This 6-step blueprint is going to show you exactly how to take this theory and put it into practice, step by step. The first 3 steps are all about the big picture, our high time frame setup. Think of this like our strategic map, maybe on the 5-minute chart. So, step 1, we look for a liquidity sweep. That's when price dips below a key low to grab orders. Step 2, we need confirmation. We wait for that big impulse break we talked about. And step 3, we mark our zone. We find that demand zone with the imbalance, and that becomes our official area of interest. Okay, for the second half, we zoom in. This is all about precision on a lower time frame, like the 1-minute chart. So step 4 is all about patience. We just wait for price to come back to us to enter our zone. Step 5, we need that final confirmation, a new, smaller impulse break on the 1-minute chart to give us the green light. And then finally, step 6, we pull the trigger, we execute the trade with a tight stop loss and aim for that session liquidity we identified earlier. All right, theory is one thing, but seeing this thing work in the real world, that's what it's all about. So let's do it. Let's watch this entire 6-step blueprint play out on a real trade. This is where all the pieces come together. So here's the setup. We're on the Euro-USD 5-minute chart. The Asia session has just finished, and it's left us with a pretty clear high and low. Now, as London opens, you can see price starts to dip below that Asia low. So the question is this a real move down, or is it a trap being set for a move up? And what do you know?
There it is, step 1. Price dives right below that Asia low. This is that liquidity sweep we were looking for. It's often called a stop hunt because that's exactly what it's doing. It's tricking sellers to jump in short, and it's stopping out anyone who bought too early. It's basically cleaning house before the real move. This little dip right here, that's the trigger for our entire setup.
And then right after that sweep, bam! Look at that candle. A huge, powerful bullish candle just explodes to the upside, breaking the previous structure. That, my friends, is step 2, our impulse break. That's the market basically screaming at us, hey, that move down was totally fake. The buyers are in charge now. Okay, so impulse break is confirmed. Now we move on to step 3. We go back and we mark the spot where that whole move started. That's our 5-minute demand zone. And we also mark that little fair value gap that was created. This whole shaded area now becomes our high probability zone. Our job now? Simple. We wait.
And this is where using multiple time frames is so important. The 5-minute chart gave us our roadmap, our area of interest. Now, as price pulls back into our zone, we drill down. We go to the 1-minute chart to get our magnifying glass out. We're not just going to buy blindly because price touched the box. We need that final confirmation, another small impulse break on the 1-minute chart to tell us this zone is for real.
And here we go, the final step. Step 6, execution. Once we get that confirmation break on the 1-minute chart, we identify the new tiny demand zone it created. That's where we place our entry. Our stop loss goes safely below the low, and our target? We're aiming for that juicy liquidity pool from an earlier session. This setup gives us an absolutely killer risk to reward. So what happened? It played out perfectly, just like a textbook example. Price rallied, smashed through our target, and just kept on going toward those higher liquidity pools. It's a beautiful demonstration of that whole manipulation distribution cycle in action. So why does this work so well? Let's kind of wrap things up by really hammering home the core idea here, because it's not about any single one of these things. It's about how they all work together. The real secret, if you can call it that, is confluence. It's just a fancy word for combining a bunch of high probability things all at once. We're taking a momentum shift on our big picture chart, we're getting final confirmation on our zoomed in chart, we're entering at a really key price level, and we're targeting a logical money-filled area. That's it. We're just systematically stacking the odds in our favor. And that really brings us to the big takeaway, doesn't it? It's not about finding one perfect, lucky trade. It's about having a process, a system that you can rely on day in and day out. So I'll just leave you with this one question to think about. Could a truly repeatable system be the one thing that you've been missing in your trading journey?